The Secrets of Quantitative Investing with Simon Judes. Simon is Co-Chief Investment Officer with overall responsibility for investment and research. He is also a member of Winton's Executive Management and Investment Committees. Simon joined Winton in 2008 as a researcher focused on designing commodity trading systems. In subsequent years, he led research into new macro and equities trading strategies and portfolio construction methods, before taking overall responsibility for future strategies in 2016. Simon has a first-class honors degree in physics and philosophy from Oxford University, and a PhD in physics from Columbia University, with a thesis on string theory and cosmology. Winton Group, including Winton Capital Management, is a British investment management firm founded by David Harding. The company trades on more than 100 global futures markets in a wide variety of asset classes and on global equity markets. The firm was launched with US $1.6 million in 1997, reached a peak of $28.5 billion in assets under advisement before dropping to $7.3 billion by late 2020. Simon summarizes a list of thoughts for data science in asset management that may help university students. Empirical research is key. The firm's philosophy is rooted in applying empirical, scientific research methods to financial markets. This means approaching markets with an open mind and a willingness to discover strategies through data, rather than starting with preconceived economic theories. Markets aren't perfectly efficient. The foundational belief is that the efficient market hypothesis is not entirely correct, and that rigorous scientific analysis can lead to successful market predictions. Some data science best practices, such as avoiding data mining traps. The term data mining is often used negatively to describe finding random, non-predictive patterns. To avoid this, it's crucial to use robust statistical techniques, especially those designed for testing multiple hypotheses. This helps ensure that the patterns you find are statistically significant and not just a result of chance. Balancing statistical evidence with economic rationale. When developing a new signal or strategy, confidence is built in two ways. First, statistical proof. Strong backtesting results that show a genuine improvement in metrics like the Sharpe ratio and low correlation to existing strategies. Second, economic rationale. An underlying economic reason for why the signal should work. While a strong economic story adds confidence, an idea with powerful statistical evidence should not be discarded simply because the rationale isn't obvious. Think of machine learning as a tool for the right problem, such as understanding data is the limiting factor. Machine learning algorithms are powerful but require vast amounts of training data to be effective. Speed dependency is crucial. The usefulness of ML in trading is highly dependent on the trading frequency. Slow trading, example daily or weekly. For slower strategies, there often isn't enough data available for significant market events like crashes to effectively train an ML model. This is compared to an observational science, where you can't just run new experiments to generate more data. Fast intraday trading. For high-frequency strategies, the sheer volume of data makes machine learning an extremely useful and applicable tool. This is more like an experimental science, where you can gather new data points constantly. Care about the human element in a systematic world. The algorithm of algorithms problem. While the goal is automation, you cannot have algorithms making every decision. If an algorithm sets a parameter, another algorithm would be needed to set the parameters for that first algorithm, leading to an infinite loop. Ultimately, a human must take responsibility. Avoiding the black box. To ensure understanding and accountability, key strategic decisions, like the speed of a trend-following system or overall asset allocation, are made by humans. This prevents the system from becoming an opaque black box, where it's impossible to understand why a decision was made.
Managing $60 billion through quant strategies with Matt Dorston. Matt Dorston is Portfolio Manager Quantitative Strategies for PIMCO, Prior to joining PIMCO in 2006, he received his PhD in theoretical particle physics from the California Institute of Technology, where he was a National Science Foundation Graduate Research Fellow. He has 16 years of investment experience and holds undergraduate degrees in mathematics and physics from Ohio State University. Pacific Investment Management Company, LLC, or PIMCO, is an American investment management firm. While it has a specific focus on active fixed income management worldwide, it manages investments in many asset classes, including fixed income, equities, and other financial assets across public and private markets. PIMCO is one of the largest investment managers actively managing more than $2 trillion in assets for central banks, sovereign wealth funds, pension funds, corporations, foundations, and endowments, as well as individual investors around the world. According to the Sovereign Wealth Fund Institute, PIMCO is the sixth largest asset manager in the world by managed AUM. Matt shares some useful thoughts for data science students in asset management. Broad universe is essential. For a trend-following strategy to be successful, it must have exposure to a very broad and diverse universe of assets. This includes having significant positions in strange corners of the market, like European power or Hungarian interest rates, not just the most common assets. The rarity of strong trends necessitates casting a wide net. Defensive profile is the priority. The primary objective of the strategy is to be defensive, meaning it should have a negative correlation to equities during crises. This protective characteristic is considered more important than maximizing absolute returns. Any new strategy or signal is evaluated on whether it enhances or maintains this defensive posture. Asymmetric risk approach. The strategy intentionally limits its exposure to risk-on assets like equities, oil, and emerging market currencies. This equity beta cap makes the portfolio more defensive and helps mitigate losses during sudden market reversals. Interestingly, historical data shows no correlation between this defensive posture and lower future returns. Technical insights for data scientists. Trend following as option replication. Mechanically, trend following behaves like replicating a portfolio of long options. As a trend moves in your favor, you add to the position, which is similar to how a long option's delta increases. This explains the convex, crisis alpha nature of the strategy. The speed of the strategy matters. A faster trend follower with average hold periods of 1 to 2 months tends to be more defensive than a slower one. This is because a faster system is effectively replicating shorter maturity options which have higher convexity, gamma, and thus provide larger payoffs during tail events. Degradation in common markets. Over time, the performance of trend-following strategies has degraded in the most common liquid markets. However, performance has remained more robust in exotic, harder-to-access markets, reinforcing the need for a broad universe. Finally, some comments on machine learning. Limited application in trend following. Despite being a buzz topic, machine learning has not yet shown obvious or consistent use cases in the trend following space for this firm. The complexity and devil in the details of managing data and execution across many exotic markets are seen as more critical challenges than applying complex ML models. The AI hype within investing is a step too far? A conversation with Robert Carver. Robert Carver is an author and systematic trader. Between 2006 and 2014, he worked within the quantitative AHL department within Man Group and was responsible for the fixed income fund with peak assets of $2 billion. Man AHL is a team of researchers, developers, and traders of systematic investment strategies. They apply scientific rigor and robust technology to diverse collections of data and hundreds of global markets. Through their innovative and collaborative culture, they aim to generate returns for their clients across a range of diversified products. With more than 30 years' experience of research and innovation, Man AHL has been one of the longest-running systematic managers. Man AHL was founded in 1987 as a commodity trading advisor, with Man Group initially taking a majority stake in the business in 1989 before acquiring the remaining share in 1994. From an initial focus on trend-following strategies, Man AHL has evolved into a multi-strategy quant business. Robert states the promise and application of AI in systematic trading as the following key takeaways. First, data harvesting and new alpha sources. The financial industry is rapidly adopting AI and machine learning to harvest and extract insights from a vast array of new and alternative data sources. The goal is to find alpha or sentiment that isn't available in conventional financial data. Second, practical application in risk management. A key practical application of AI is not necessarily for generating entry signals, but for enhancing risk management and optimizing exit strategies. Machine learning models can be trained on massive historical datasets to recognize patterns that precede downturns or signal the best time to take profits, leading to smoother return profiles. Third, detecting nonlinear patterns. Advanced AI, beyond the reach of average users, has the potential to detect weird, unusual, nonlinear patterns in financial data that traditional models might miss. However, some critical challenges and risks for data scientists. For example, the paramount risk of overfitting. This is the most significant concern raised. The use of highly complex models, like large language models, LLMs, dramatically increases the risk of overfitting. A model might show spectacular performance in backtesting or in-sample by fitting to noise, but then fail significantly in live trading or out-of-sample. The more granular and complex the model, the higher this risk becomes. Skepticism towards LLMs. There is strong skepticism about the reliability and truthfulness of off-the-shelf LLMs for generating trading signals. They can be excellent at summarizing information, but are prone to inaccuracies, hallucinations, making them highly risky for direct application in trading without rigorous verification. Questioning the value and longevity of AI models. It is crucial to critically assess the true value add of any new AI tool or data source. Key questions a data scientist must ask are, how long can the value from this data or model last before the alpha decays? What are the best methods to rigorously assess the value it claims to deliver? Transparency and liability. A major concern with using AI is the black box problem. If a model makes a decision that leads to significant losses, the lack of complete transparency makes it difficult to understand why the decision was made and to determine liability. This contrasts sharply with the clear, rule-based nature of traditional systematic strategies like trend following. The need for robust validation. Financial market data is radically non-normal and has heavy tails. Standard statistical methods that assume normality are inappropriate. Any AI model must be built on robust, distribution-free statistics and validated through a rigorous process, a gauntlet, to ensure it holds up under real-world conditions.
The untold side of the turtle trading legacy with Bill Eckhart. Bill is a commodities and futures trader and fund manager. He began trading in 1974 after 4 years of doctoral research at the University of Chicago in mathematical logic. In 1991, he founded Eckhart Trading Company, which is an alternative investment management firm specializing in the trading of global financial futures and commodities, which manages over $1 billion in managed accounts, domestic and offshore products. The firm's international clientele includes fund of funds, corporate, private, and institutional investors. Bill mentioned the following insightful comments and suggestions for data science students who want to find a career in asset management. Risk control over prediction. Successful trading is more about risk control than predicting market movements. The markets are too close to random for simple predictions to be consistently accurate. The focus should be on having a plan for when the market moves and not on predicting where it will go. Utility theory and risk aversion.
Utility theory suggests that each additional dollar gained is marginally less valuable than the last, while each dollar lost has a greater impact. A mathematical understanding of risk aversion is essential for success in futures trading. Non-normal distribution of futures. The probability distributions of price changes in futures markets are not normal and have heavy tails, especially on the loss side. This means that standard statistical methods assuming a normal distribution, like standard deviation and linear regression, are not appropriate and can lead to incorrect conclusions. Use robust distribution-free statistics. To accurately analyze futures data, it's recommended to use robust or distribution-free statistics which do not assume a particular distribution. However, these methods require significantly more data to make reliable inferences. Overfitting and underfitting. It's important to fit trading models to the permanent features of a time series while ignoring temporary noise. Overfitting can lead to financial ruin, but underfitting, not using all worthwhile market information, is also detrimental. Rigorous system validation. It is important to have a rigorous testing process to scrutinize and attempt to tear apart trading systems to ensure they are robust and avoid making money only over short, isolated periods. Diversification and liquidity in market selection. Diversification is a key principle in finance. When selecting markets, liquidity and trade slippage are critical factors to consider in addition to trending properties. Futures versus stocks. Futures and stocks are fundamentally different. Futures markets are perfectly balanced between long and short positions, while stock markets are dominated by long positions. Futures also tend to have more robust trend components than individual stocks. Summary statistics. Summary statistics like moving averages can obscure important market structure when used for trading signals. While they are appropriate for estimating volatility, they are not suitable for price analysis because price is not a stationary moving average process. Low success rate, high payoff. Successful trading systems often have a low success rate, around 40%, but the winning trades are significantly larger than the losing trades. Systems with very high success rates are often prone to large, unexpected losses.
Inside Calculo Capital, Crushing Commodity Markets with Machine Learning. A conversation with Philip Engel Carlson. Philip is CEO and founder of Calculo Capital. Calculo Capital's investment strategy is specifically designed to accommodate the Calculo strategy while eliminating manual processes and operational risks. The strategy targets long-term capital appreciation through investments in commodity futures, employing its proprietary trend-based trading system. The strategy is built on a core foundation of strict trading rules supported by machine learning algorithms. Philip mentioned the following insightful comments and suggestions for data science students who want to find a career in asset management. Machine learning for risk management. The speakers emphasize using machine learning for risk management and creating exit strategies rather than for generating initial entry signals. They rely on trends for entry and use machine learning to determine when to take profits or exit positions. This suggests that a practical application of machine learning in asset management is to refine and optimize existing strategies. Capturing alpha moves. The firm's goal is to capture alpha movements within existing trends and use AI to manage exits. This approach helps to create a smoother return profile with less volatility. Price pattern recognition. The primary entry strategy is based on price patterns, specifically classical CTA-style breakouts. The systems are trained to recognize specific sequences of price events or new highs or lows to initiate a trade. Data inputs for machine learning. For their machine learning exit models, the firm collects various daily data points, including candlestick patterns, momentum angle, and other momentum indicators. Database matching for exit decisions. The daily data patterns for a trade are compared against a large historical database of similar trades. By analyzing the outcomes of these historical trades, the system can inform the decision to keep or sell a position. Adaptive and timed exits.
The firm uses advanced algorithms for market entry and adaptive execution for exits. Machine learning-driven exits are often timed to occur during liquid periods, especially during U.S. market hours, as they are seen as indicators of potential corrections rather than definite market collapses. Systematic and automated process. The entire trading process from signal selection to execution is fully systematic and automated, with no manual overrides in the signal selection process.
Investing in the age of AI, uncertainty, and data overload with Nick Baltas of Goldman Sachs. Nick is a managing director and head of R&D, cross-asset Delta One and commodity systematic trading strategies at Goldman Sachs. Prior to joining Goldman Sachs in 2017, Nick was an executive director in the quantitative research unit of UBS. Previously, he was a lecturer in finance at Imperial College Business School, a visiting lecturer at Queen Mary University of London, as well as a risk manager in a London-based hedge fund. Nick holds an undergraduate degree in electrical and computer engineering from National Technical University of Athens, an MSc from Imperial College London in communications and signal processing, and PhD from Imperial College Business School in finance. Nick mentioned the following insightful comments and suggestions for data science students who want to find a career in asset management. AI and data harvesting. The financial industry is increasingly using machine learning and AI to extract data. New vendors are constantly emerging with algorithms to find insights not available in conventional data. Evaluating new data sources. It's crucial to question the value of new data sources and AI tools. You should consider how long the value of the data will last, the best ways to assess its value, and how its effectiveness might decay over time. Skepticism of large language models, LLMs. Be cautious when using LLMs. While they can be good at summarizing information, they can also be inaccurate, so it's important to verify their outputs. Balancing innovation and caution. Asset managers need to find a balance between adopting new technologies and avoiding those that don't add real value. This means carefully deciding which innovations to focus on. Dynamic volatility targeting. Instead of using a static volatility target, systematic strategies can benefit from dynamically adjusting the target based on market conditions. This can help mitigate losses, even if it means missing out on some potential gains. Market regimes and strategy design. The increasing frequency of V-shaped market recoveries may require rethinking existing investment strategies. This could involve redesigning strategies or managing risk differently to account for these quicker reversals. The difficulty of market timing. Timing the market, especially for trend-following strategies, is generally considered impossible. These strategies should be viewed as long-term, strategic allocations that provide diversification and act as a form of statistical insurance during prolonged market downturns. Market evolution and systematic investing. It's an ongoing debate whether markets have fundamentally changed, making traditional systematic rules obsolete. The consensus is to avoid emotional reactions and instead focus on continuous innovation and improvement of systematic approaches in response to market evolution.
The impact of UAPs and AI on the global finance market with Jay Anderson. Jay Anderson is the founder and curator of the popular YouTube podcast, Project Unity. As an experiencer himself, Jay is dedicated towards bringing credible research and researchers to the forefront of modern discourse on UFO phenomena and its intrinsic connection to the mysteries of human consciousness. Jay shares some useful thoughts for data science students in asset management. Open source data and AI. Jay emphasizes the growing importance of open-source tools and data for analysis, rather than relying on sanctioned information. This highlights a trend that data science students should be aware of, as open-source resources are becoming increasingly powerful and prevalent. AI for identifying hidden correlations. The JERA project, an AI-leveraged solution, is designed to identify hidden correlations within global events. This demonstrates the potential of AI to find non-obvious relationships in vast datasets, a skill that is highly valuable in asset management for tasks like identifying market trends and forecasting. Practical application of AI. As an example, JARO was used to correlate UFO sightings with the proximity of U.S. military bases, producing a map that showed a significant correlation. This showcases how data science can be applied to complex and niche datasets to uncover meaningful patterns. AI for forecasting and global trends. The JARA project illustrates how AI can be used for forecasting in various markets and for understanding global trends that human analysts might miss. This underscores the increasing role of AI in predictive analytics for asset management. Rapid pace of AI development. The AI industry is growing exponentially, with open-source communities quickly catching up to and even surpassing the developments of large, well-funded firms. This suggests that data science students should pay close attention to open-source advancements, as they have the potential to disrupt established market leaders. Quantum computing. In addition to AI, quantum computing is another exponentially developing field that should not be ignored. The combination of AI and quantum computing is seen as a major inflection point with profound implications, highlighting the importance of understanding synergistic technological advancements. Exponential thinking. The hosts discuss how the human brain struggles with exponential thinking, which can be an arbitrage opportunity in markets. Data science students can apply this concept to identify and capitalize on rapidly evolving technological trends.
How AI may impact trend following with Mark Rzyszczyński. Mark is founding partner, CEO at Amphi Research and Trading. Prior to co-founding Amphi, Mark was the CEO of the fund group at Four Winds Capital Management. Mark was also president and CIO at John W. Henry & Co., an iconic commodity trading advisor. Mark has headed fixed income research at Fidelity Management and Research, served as a senior economist for the CME, and as a finance professor at the University of Houston Bayer School of Business. Mark has an undergraduate degree in economics from Loyola University and an AM and PhD in economics from Brown University. Mark shares some useful comments and thoughts for data science students interested in asset management. Momentum versus trend following. The video distinguishes between momentum and trend following strategies. Momentum strategies rank a cross-section of stocks based on past returns and create a market-neutral portfolio by buying the top-ranked and selling the bottom-ranked stocks. Trend following, on the other hand, analyzes individual markets as time series to generate buy or sell signals. The importance of exit strategies. The exit strategy is crucial for a trading strategy's success, as it determines how much of a trend is captured. Optimizing exits is essential to prevent giving back profits and to allow for the redeployment of capital into better performing trades. The challenges and uses of AI and machine learning in asset management, such as expanded toolset. Machine learning and AI have expanded the modeler's toolset beyond traditional methods to include neural networks, random forests, and gradient boosting. New burdens. This expanded toolset requires researchers to identify the right tool for the right problem and to evaluate the marginal improvement offered by new tools. Nonlinearity and analog decisions. Machine learning techniques are valuable for identifying nonlinearities in financial markets and for transforming trading decisions from binary, yes-no, to analog, based on probabilities. Model failure and robustness. Out-of-sample degradation. Models often perform worse out-of-sample than in-sample, with a typical degradation of 30 to 40% in the Sharpe ratio. Market frictions. It is crucial to account for transaction costs and liquidity to minimize the difference between a model's theoretical performance and its actual trading results. The VUCA framework can be used to improve model robustness. Volatility. Ensure the training data includes diverse market regimes. Uncertainty, complexity. Favor simpler models to avoid overfitting. Ambiguity. Use a long enough sample size for training. Parameter uncertainty. Acknowledge that the chosen parameters may not be optimal in the future. Interpreting performance. A model with a lower in-sample Sharpe ratio but more stable out-of-sample performance may be preferable to a model with a higher in-sample Sharpe ratio but less stable out-of-sample performance. Based on the video, here is a more focused summary of the key findings on AI and machine learning for data science students in asset management. The expanded toolkit and its implications. Beyond traditional models, AI and machine learning have fundamentally expanded the toolkit available to quantitative researchers. Instead of being limited to linear regression and simple binary rules, modelers now have access to a wide array of sophisticated techniques, including neural networks, random forests, and gradient boosting. The burden of choice. This expanded toolkit creates a new challenge for data scientists: the burden of choice. It is no longer enough to just build a model. Researchers must now judiciously select the right tool for the right problem and be able to rigorously evaluate whether a complex new technique offers a genuine, marginal improvement over a simpler, more traditional one. Key applications and advantages of ML/AI, such as capturing nonlinearity. A significant advantage of machine learning is its ability to identify and model nonlinear relationships in financial markets. This is particularly useful for capturing events like sudden breakouts from a trading range, which linear models would struggle to predict. From binary to analog decisions. AI allows for a shift from simple binary yes-no trading decisions to more nuanced, analog or probabilistic approaches. Instead of just deciding whether to be in or out of a trade, a model can assess the probability of a trend continuing, allowing for more sophisticated position sizing and risk management. Uncertainty around LLMs for time series forecasting. While there is a lot of investment and hype around using large language models for financial time series forecasting, early research suggests they may not add as much value as one might think. Their ultimate success in this specific domain remains an open and uncertain question. Experience versus technology. While new technologies like AI are powerful, the asset management industry has a long history of adapting to technological revolutions. Established strategies like trend following have persisted through many such changes. Real-world trading experience, which is difficult to backtest or replicate with AI, remains a valuable and distinct asset.